Yeah, the activity data yesterday was just woeful, Kyle. It really was much worse than everybody was expecting, and I think we're starting to see the ramifications of that in terms of the big banks will start to slash their GDP forecasts again. They've already done it because of the lockdowns, but what we saw yesterday justifies further slashing of GDP forecasts to the point that we're looking now for GDP for 2022 in China to be closer to 3.5%, not the 5.5% that the Chinese policymakers target, and certainly a long way from that 8.1% level we saw last year. Now, with the economy, or with Shanghai still in lockdown, it doesn't make a lot of sense for them to start unleashing waves of stimulus. Because stimulus doesn't work if people are still in lockdowns, and at the very latest, we think that those lockdowns probably start to ease sometimes next week. Possibly by June 1, we're looking at a full reopening. So there's still 2 weeks left to go before we actually start to see the reopening which we want to see there. In which case, it suggests that the easy lever for the Chinese authorities to pull is through the currency. Now, the dollar CNY chart you see there shows that it's already rallied quite significantly from around 6.40 up to around 6.80. And what I suspect happens is, as we mentioned, there's no point playing around too much with monetary policy, unleashing fiscal stimulus or infrastructure projects. It really is a currency story. I suspect you look to buy dollar CNY down towards 6.70, looking for another blow off up towards 700 before this economy, this massive economy. What they're trying to do is just turn around a super tanker, and it doesn't happen easily. It's going to take time, in which case the currency remains that easy lever, and it could push up towards 7. Now, that plays out as well in terms of the other currency pairs that we're looking at, because if dollar CNY is rallying, it probably means that the euro and the Aussie stay under pressure to a degree as well as the yen.